welcome to Indianomics on the all-important first quarter GDP numbers. The first quarter GDP at 6.7 has been mistakenly described as the lowest in 5 quarters. If one looked at the gross value added or GVA number at 6.8, it is actually stronger than the previous quarter's 6.3%, that is Jan-Feb-March quarter. And yet, whether it is GVA or GDP, it is not touching the aspirational 7% mark or the Reserve Bank's forecast of 7.1%. To understand the Q1 growth numbers and the likely trend for the full year, I have with me an elite panel of economists. Joining me are Samiran Chakrabarty of Citi, Sonal Varma, the Managing Director, Chief Economist at Nomura Financial Advisory, Abhishek Upadhyay, Senior Economist at ICICI Securities Primary Dealership, and Madhavi Arora, Lead Economist at Emkay Global. Ladies and gentlemen, thank you very much indeed for your time. Samiran, let me start with you. Should we call this a good number? Whether it's 6.7 or 6.8, it's falling short of the aspirational 7%.
Good morning, Latha. I think the way we have looked at this number is that it's the internals of the numbers are slightly better than what we had probably anticipated. There were two distortionary effects in this quarter, one from the elections, the other from the heat waves. The election impact primarily would have been felt on the government consumption expenditure and the heat wave impact on agriculture. Now, if you look at these two components only, the government consumption expenditure grew at minus 0.2%, so contributed basically 0 basis points to GDP growth. And agriculture contributed about 30 basis points to GDP growth. Now, for both of them, the historical average contribution is about 30 basis points and 60 basis points respectively. So if you think of some sort of a normalization of these two factors over the next couple of quarters, then that gap between the 7% aspirational number that you were talking of and the reported number, that gap could easily be bridged.
Okay.
So our sense is that we should be going back to the 7% print very soon once these two effects normalize.
Okay, I'll come to you on when you see that normalizing. But Sonal Varma, we have your report, and you are actually forecasting a lower GDP. You've brought down your forecast.
That's right, Latha. We've cut FY25 from 6.9 to 6.7. I'd agree with what Samiran has said in terms of internals being better than the headline, and that some of the effects, particularly government spending, is going to normalize in the coming quarters. But I think that needs to be seen in the context of what's happening more broadly. And there are 2-3 things to keep in mind here. One is, in our view, the urban consumer side is actually slowing. In fact, I'd point out most of the high-frequency data we've got for July and now for August have been weak. Passenger vehicle sales negative. We are seeing inventory build-up. Medium and heavy commercial vehicle sales contraction again in the month of August. Cement demand weak. So we are seeing signs of softness in high-frequency data. We think credit growth is going to moderate, and some of the excess consumer demand on the urban side is going to moderate. Second, the big boost to GDP from corporate profitability because of lower input costs, that's clearly behind us. And therefore, GDP growth is likely to be lower and probably closer to GVA growth going forward. And third, I think global demand actually is soft, whether it's China, Europe, or even US on the labor market side. Things are slowing at the margin, and that we think is also going to be a headwind. So while the government consumption, government spending, and agriculture-related activity will rebound, it's going to happen in this backdrop. And therefore, we think it's quite likely that GDP growth and GVA growth remain in the 6.5% to 7% range in the next 3 quarters. So we see it extremely unlikely that GDP is going to be at 7 or higher in FY25.
Okay. Abhishek, on that note, let me come to you. I was pretty elated by the private final consumption number coming in at 7.5% almost. It was just 4% if you take the average of the last 4 quarters. shouldn't one be therefore banking on better rural recovery, leading to a better multiplier effect?
Latha, we think, I mean, the 4% private consumption growth in second half last year as well as for full year was understated. Typically, there are measurement issues when you come to estimating the GDP internals. And if you look at the contribution of discrepancies, which was as high as 52% to overall GDP growth last year, that makes it very difficult to really interpret these private consumption growth numbers with any sense of confidence. So we think true consumption growth would have been higher, and you would get that sense if you look at two-wheeler sales, which are up uh, 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 14% last year,
Yes.
passenger vehicle sales up 22% last year. So with indicators of discretionary consumption doing reasonably well, 4% growth looked somewhat basically an anomaly.
Okay.
So while growth has picked up there, we think this acceleration is also exaggerated.
Okay.
That said, we do see signs that consumption recovery is broadening out. If you look at the social services growth component on the GVA side, you don't get that breakup separately. But if you overlap the government consumption expenditure on the GDP side and view the public administration, defense, other services on the GVA side, you see signs clearly that overall consumption recovery is broadening out. Yes, high frequency data this quarter, last quarter was mixed. Urban consumption seems to have slowed down a bit. But overall, theme wise, with inflation slowing down, with rainfall, uh, uh, rains also recovering from July onwards, we see reasons for cautious optimism on the consumption front.
Okay, that's what I would think, because the PMI data actually has been reasonably strong. I mean, you can squabble about it month on month being here and there. And what about the August two-wheeler? It's really strong, the TVS and other numbers that we have got. It is only CV and which is not showing growth. So can you weigh in on that, Madhavi? Would you agree that consumption actually has recovered and maybe a stimulus for the coming quarters?
Hi, Latha. Perhaps the most encouraging news from the GDP data was how private consumption actually has jumped up. In fact, it converged with the GFCF. And last year, it almost averaged close to around 4%. And the sprint was pretty encouraging when you saw 7.4% in the first quarter. While this is very encouraging, one needs to see this trend sort of sustained, because one thing is there that the quarterly expenditure data is extremely volatile. And as I know other panelists were also mentioning, even as the rural consumption is firming, when you're looking at these two-wheeler sales and FMCG sales, which are now moved by the rural sector, there are clear signs that the urban consumption is slowing. So I think that would be the next lever to watch out for, because while there's a convergence that we're seeing between consumption and even capital formation, we'll have to see whether that continues. For that matter, we'll have to actually reckon the fact that much of the GFCF has been essentially moved by the government capex
Yes.
and real estate. For the corporate capex to fire, especially in the world which is flooded by excess capacity of Chinese economy and low demand visibility, it has to be really seen whether we see continuation in GFCF which goes beyond the government sector. And for that, I think private consumption and exports will have to fare comfortably well for the coming quarters for the GFCF in the private sector to actually fire off.
Okay, got that. GFCF, by the way, economists say that they mean capital formation. Actually, Samiran, can you weigh in on that? You pointed out that government the government expenditure contracted by 0.2% in the quarter under review. But, public administration, that number was high, 9.5% it grew. And as Madhavi points out, capital formation is 7.5%. Even though government spend, we know from the fiscal data, it was 35% lower for April, May, June. So are you encouraged that private capex has picked up?
Absolutely. I mean, the 0.2 number, by the way, is government consumption expenditure, so that does not take care of the capex part. But the capex was down even more, as you pointed out, in the monthly fiscal data that we get. So despite that, if we are seeing this much of investment growth, then either it could be the private corporate side, or it could be the real estate side, the household capex. Now, our hunch is looking at the construction sector data that there is a significant increase in the real estate side as well, because otherwise you wouldn't have seen a construction growth of 10.5%, despite some of the internals of the construction sector, some of the proxy indicators not being that good, like cement demand has been weak for the quarter. Despite that, we have seen a very high construction growth. And I will connect that with the household capex. But still, I would say that private capex was holding up. Otherwise, we wouldn't have got a 7.5 kind of overall investment growth.
Okay. God, that seemed encouraging to me as well. Sonal, would you be at least convinced that consumption is at least on a recovery mode, as is private capex?
Latha, I think, yes, consumption should, on aggregate, do better. And lower inflation itself is actually a big positive on the rural side. So I think what we're basically seeing is a rebalancing under the surface. And particularly this rural recovery theme does have more legs, for various reasons, including lower inflation and better production, for farmers. Urban side, though, I think is likely to soften. It is more discretionary, more sensitive to credit availability, and that aspect we think will soften. But on aggregate, I think inflation coming down itself is a positive for consumption. Private capex side, Latha, I think we need to split it into government, private, corporate, and the real estate side. So the government side is where we should see a pickup and a catch-up post-elections, and we did see that in the July capex data from the central government, which was up over 100% on a year-over-year basis. So that component should pick up. The housing side as well, there are still a lot of tailwinds, and we do think housing-related investment will pick up. The private corporate side, though, is where we would describe it as still quite mixed. I think yes, capacity utilization is picking up, but if you break that down by different sectors, it's fairly concentrated in a few sectors, and the global backdrop to us does not look conducive for a broad basing of private corporate capex recovery. So a lot of changes beneath the surface, Latha, both in terms of consumption as well as on the investment side.
Okay, a point taken, Sonal, but I have to take a mandatory break. There are some very important questions left. Will we make it to the 7% mark? What factors can help us, private capex and consumption? And how will the Reserve Bank interpret this number in terms of rate action? All those questions to my guests after a very short break. Stay with us. Welcome back on Indianomics. We have been parsing the first quarter GDP numbers, and the key question that I have in my head is, from the 6.8% GVA, can we make it to the magical 7% mark? I've been speaking with Abhishek Upadhyay of ISec, Madhavi Arora of Emkay, Sonal Varma of Nomura, and Samiran Chakrabarty of Citi. Well, let me ask you that, Abhishek. What are the chances that we will be able to, because of the improved consumption and the clear fact that the government will spend more on capex, what was lost in the April, May, June months will be, overdone, made up for. What are the chances we get to 7?
Rather, we have retained 6.8% forecast for GVA, but I do agree that looking at the internals, with capex growth staying resilient despite a near collapse in government capex, and for context, government capex is roughly about 25% of overall capex, and we saw a sharp contraction there with resilient capex, with consumption demand, there is scope for it to pick up. Also on the global side, what we are seeing is the worst case scenarios are not playing out. So you have increased talk of soft landing in US. Also commodity prices, which had risen earlier in the year, are now at levels which are below the current calendar year starting levels. So the headwind from adverse terms of trade shock also seems less severe than what we were thinking earlier. So, given all these drivers, uh, uh, there should be some case for optimism, and more likely that we are going to revise our number higher rather than lower. So,
Okay.
GVA growth likely stays here slightly higher, and GDP growth, which we are currently penciling at 6.5%, could be closer to GVA growth as well. So, these internal support case for upgrade rather than
Okay.
downgrade in our view.
Okay, so 6.8% and the a chance of an upgrade. Madhavi, what would you say? Uh, are you finding the private capex and the likely government capex positive enough to engender 7%?
So, Latha, we are maintaining our forecast 6.5%, which is what it was, I think, 6 months ago. Also, I was of the view that we will be seeing a slower manufacturing story in FY25, and that is what I maintain. And for that matter, consumption also looks to be a very patchy story as of now. Of course,
Okay.
rural is picking up. You are looking at signs of rural pickup, which is as reflected in in two-wheeler sales and lower Manrega demand as well. But at the same time, even as the rural consumption lifting, you are seeing that the urban consumption appears to be slowing. If you look at the data for four-wheeler sales or even hotel occupancy rates or even consumer-related lending in general, you are looking at a much slower urban story, or maybe a K-shaped urban story for all you know, wherein the mid segment of urban actually would see a much sharper slowdown. So I think it's still too early to assume that we will be seeing a 7% growth. As of now, I'm still sticking at 6.5%. Of course, there are some tailwinds which are basically emerging in the form of strong monsoons and a
Exactly.
decently, a decent pickup in the rural consumption. But
Okay.
at the same time, you would have headwinds in the form of urban consumption, in the
Okay.
form of manufacturing growth, which will be slowing
Okay.
on account of the
Got that.
higher input costs.
Yeah.
At the same time, the deflator-led push that you got last year would also sort of fade. So I
Oh,
think to a large extent, I'm still more biased towards 6.5% than towards the
got that.
7.
No,
As of
got
now,
that.
pretty
But
much
no, I
balanced.
take your point about the K-shaped. I mean, after all, look at trade, hotels, and transport. It has just not got back the mojo that it had pre-COVID at 5.7%. And it's a fairly employment-heavy, informal-heavy sector. That's a worry, and so is agriculture. But Samiran, agriculture could be the positive, isn't it? We have a La Nina year. The rains, August rains have been excellent. There is a very good chance that the Rabi will be very good. So, what are the chances that the only thing that is keeping the Reserve Bank from cutting is food inflation, which could be, the peak is completely over. And we saw, I think the nowcast is showing cereal and pulses prices, even veggies, other than potatoes and onions, crashing. A rate cut possibility and your growth improvement chances.
So clearly, agriculture, all the indicators from the monsoon has been quite good. It's not just the quantity of rainfall, but also the quality of rainfall. The temporal and spatial has been good. Also, the sowing pattern has been exactly in line with estimates. So, barring any random shocks from unseasonal rains or heat waves, this should be the rest of the quarters should contribute very positively agricultural growth towards GDP growth, which is why I was mentioning that we could get compared to the first quarter another 30 basis points extra on GDP growth coming from agriculture itself. Now, whether this contributes to cooling down of inflation beyond what we have already budgeted, that remains to be seen.
No, but the second
We
quarter
get a
is, one minute, let me interrupt. Second quarter is definitely not 4.4. The Reserve Bank's forecast seems to be clearly higher, especially when you see the nowcast numbers for food. So you don't think that there is a chance of an undershoot of 4.5? No?
So the point is that the central bank has been very clearly articulating that they want a 4% headline CPI on a durable basis. Now, yes, it could be that this quarter would be slightly lower than the RBI estimates, but if the base effect will catch up on the other side, in the next quarter, we're going to see numbers which are probably in the 4.5 to 5 range. So would that be comfortable for the central bank to cut rates? At this moment, the communication seems to suggest that that's not the case, which is why we haven't brought forward our rate cut expectation. What could change things is that if for some reason growth numbers disappoint, maybe because of the global shocks, then the balance of risks could change.
Okay.
Right now, the balance of risks is entirely towards inflation. That could be more normalized and could bring forward rate cut expectations.
Okay. Well, yeah, there is, of course, the global risk. There is the November election. So we really do not know whether these imponderables will come. But Sonal, you're the only person I know from the many reports I've read who has lowered, and I think Goldman has also lowered earlier their growth forecast. What will be the falsification thesis? I mean, what can falsify or make you give an upper thrust to the GDP?
Yeah, Latha, I mean, I think some of the, high frequency numbers that are moderating, if they don't moderate, and you see alongside that, some of the transitory factors that will grow down in terms of government spending or heat wave, that's a scenario where growth gets closer to 7%. So essentially, we're talking about, credit growth staying strong, consumer demand coming back in a big way, construction-related indicators picking up again, and potentially also I'd throw in the mix the global backdrop. I think it's still quite uncertain in terms of the path ahead. But if we do get a soft landing in the US, that's actually pretty good for India, because if you have soft landing in the US and a relatively soft China, then you have, easier financial conditions, better growth, and low commodity prices. So that combination could also be quite positive for India.
Okay, yeah, absolutely. The last US GDP number for Q2 has been revised up from 2.2 all the way to 3%. So I'm not very sure that the much feared global slowdown is as yet with us. Probably some more data is needed. I'm told that we are out of time. So just a rapid fire, just give me your full year GDP forecasts. Abhishek?
Still 6.5, but upside
6.5.
risk.
6.5 with upside risk. Sonal?
6.7% for FY25.
And Samiran?
We are at 7.
7. Madhavi?
6.5%.
Okay, fine. So, well, it's a city which is more confident than the others, but others are also, at least Abhishek has an upside risk. Thank you very much, Madhavi, Sonal, Samiran and Abhishek for sparing time for us and for an extremely interesting and enriching discussion. And thank you all for watching Indianomics.